When people think about investing, one common topic that arises is selecting the best dividend ETF. For a long time, my favorite choice in this category was SCHD. However, I've been closely examining another option, DGRW. My analysis has shown that for over a decade, DGRW has been performing better than SCHD. A question often posed is whether DGRW's superior overall performance is sufficient to offset its higher costs and comparatively lower dividends. Can SCHD maintain its previous performance in the coming decade? And is there a possibility that DGRW might offer greater growth potential than SCHD? These are crucial considerations for investors. Let's dive deeper into DGRW. This ETF is distinct, focusing on both value and dividends. It's one of the few that has shown impressive results this year, boasting a return of over 12%. In comparison, SCHD has experienced a decline of 4.37%. Although DGRW offers a smaller dividend than SCHD at just 2.1%, its total returns have been consistently higher. Over the past 10 years, DGRW has averaged annual returns of 11.78%, compared to SCHD's just over 10%. This difference, though it appears small at 1.78%, accumulates significantly over time. I plan to conduct an in-depth analysis of DGRW to demonstrate why it might be a beneficial choice for your investment portfolio, particularly with a focus on the coming 10 years. Additionally, I'll break down the numbers for both funds, considering an initial investment of $10,000. This analysis will span various timeframes, specifically looking at the returns over 1, 5, 10, and 30 years. My goal is to provide a clear and comprehensive view of how these investments could potentially perform over these periods, helping you make a more informed decision. Dividend ETFs like SCHD, VYM, and DGRW can be an excellent strategy for those seeking financial independence and passive income. Among these, DGRW has emerged as a particularly strong contender. Known as the WisdomTree U.S. Quality Dividend Growth Fund, DGRW has been awarded a 5-star rating by Morningstar, underscoring its investment potential. Imagine you invested $10,000 in DGRW a decade ago. Today, that investment would have grown to over $30,000, along with a consistent dividend income. DGRW tracks the WisdomTree U.S. Quality Dividend Growth Index, which focuses on dividend-paying stocks with growth potential, each with a market capitalization of at least $2 billion. The strategy here is to invest in companies that not only offer dividends, but are also poised for faster and more robust growth. This could mean potentially higher returns for you. The index includes 300 companies from the WisdomTree U.S. Dividend Index, selected for their strong growth and quality factors. The primary difference between DGRW and others, like SCHD and VYM, lies in their holdings. SCHD's underperformance is partially due to its minimal investment in the booming information technology sector. When an ETF overlooks such high-performing sectors, its investors miss out on potential growth. DGRW, conversely, heavily invests in information technology, followed by sectors like consumer staples, industrials, healthcare, financials, and consumer discretionary. This composition makes DGRW unique, blending a dividend-focused approach with benefits of growth in technology sectors. Leading companies in DGRW include major players like Microsoft, Apple, Broadcom, Johnson & Johnson, and Procter & Gamble. Now, back to the question. Is DGRW better than SCHD? And does it have more growth potential over the next decade? Regarding growth potential, I believe DGRW could surpass SCHD, particularly in terms of price appreciation and possible total return. The tech sector, especially with developments in AI and blockchain, is anticipated to continue its growth trajectory, and DGRW includes a broader range of such companies. Deciding which ETF is better isn't straightforward. SCHD is a robust dividend ETF, offering reliable dividends above 3.5% and a consistent total return of over 10% for the past decade. While DGRW has outperformed SCHD in total returns, your investment goals are crucial in this decision. If you seek a safer option with a solid dividend and a track record of strong companies, SCHD is a good choice. DGRW, although it includes strong companies, is less of a pure dividend ETF and more of a hybrid between growth and dividend-focused ETFs. Let's dive into the exciting part of this analysis, comparing the numbers for two funds, DGRW and SCHD, over periods of 1, 5, 10, and 30 years. Here's the basic info I use for these calculations. For DGRW, I invested $10,000 at a share price of $69.66, expecting the dividends to grow by 3% yearly and the share price to increase by 8% yearly. Dividends are paid monthly. For SCHD, I also invested $10,000, but at a share price of $76.1. Here, the dividends are expected to grow by 3% yearly, but the share price is only expected to go up by 3% yearly. Dividends are paid quarterly. Now, let's see how they did. After 1 year, DGRW's balance was $11,006.76 at a 9.77% return. The dividends added up to $176.47. After 5 years, DGRW grew to $15,868.42 with a 58.26% return. The dividends added up to $967.61. After 10 years, DGRW reached $24,723.07, a 146.57% return. The dividends added up to $2,167.57. After 30 years, DGRW skyrocketed to $131,783.82, a massive 1,214.33% return. The dividends added up to $10,063.38. Now for SCHD. After 1 year, SCHD balance was $10,623.47, a 6.54% return. The dividends added up to $348.01. After 5 years, SCHD grew to $13,685.19, a 37.24% return. The dividends added up to $1,982.88. After 10 years, SCHD reached $18,781.56, an 88.35% return. The dividends added up to $4,704.19. After 30 years, SCHD reached $66,627.66, a 568.17% return. The dividends added up to $30,252.60. While analyzing and projecting the performances of these funds, it's important to remember that these are merely educated guesses based on historical data. We look at past trends and performances to make these speculations, but it's crucial to understand that they are not absolute guarantees of future results. Market conditions can change, and various external factors can influence the performance of investments in ways that are difficult to predict. This approach helps us get a sense of potential outcomes, but like any forecast, it's not foolproof. I'd really appreciate hearing your thoughts on this matter. The world of investment is complex and always evolving, so your perspectives and insights could provide valuable context or highlight aspects I might not have considered. Please feel free to share your opinions, experiences, or any questions you might have in the comments below. Engaging in a discussion can help us all gain a more nuanced understanding of these financial predictions and the inherent uncertainties they carry. For someone like me who already has significant investments in growth ETFs like QQQ, M, SCHD, and VUG, added a hybrid ETF like DGRW doesn't align with my strategy. However, if your portfolio lacks growth ETFs and you're more focused on dividends or foundational style ETFs, incorporating DGRW could be a smart move. It might outperform SCHD in the long term in terms of total return. Yet, for those prioritizing cash flow and passive income, SCHD or VYM might be more suitable. In conclusion, the choice between SCHD, DGRW, or another ETF entirely should be based on your unique investment goals and strategy. Aligning your selections with your financial objectives, whether that's steady cash flow, long-term growth, or a balance of both, is essential. Remember, diversification is vital in any investment portfolio. Keep educating yourself, stay informed about market trends, and adjust your investments as necessary to achieve your financial goals. Happy investing, and I wish you the best on your journey to financial success.